talked about portfolio management. We understood what exactly is the meaning of portfolio management, and we also talked about certain other things like difference between risk averse and risk tolerant investor, idea of systematic versus unsystematic risk. We talked about diversification as well. Oh yes, that was a very important topic that we discussed. We talked about diversification. We talked about systematic, unsystematic risk. So what I'm going to do in this lesson is, first of all, with the help of an example, we'll again understand and revise the difference between systematic, especially the difference between systematic and unsystematic risk. The reason being that in all our future lectures, we are going to use the difference between systematic and unsystematic to a very large extent. So it becomes very important that we consistently talk about the major differences between them, take some examples so that we are more clear about the difference between systematic, S and U. Okay. So first of all, let's talk about the difference between them, and then we'll move forward and talk about standard deviation, variance, covariance, and risk can be diversifiable and non-diversifiable. So unsystematic is diversifiable and systematic is non-diversifiable. So here you have diversifiable, which is also unsystematic, non-diversifiable, which is systematic or market risk. I had taken an example to explain to you the major differences between them, but let's talk about them again. So here it says diversifiable risk is that kind of risk which can be diversified by specific techniques, company specific in nature. Non-diversifiable, on the other hand, is market risk, also called systematic, cannot be diversified. The example here is very good. It says the sales team of Parle is not as aggressive as that of Patanjali. Due to a smaller and less qualified team, Parle is losing market share in sales. This is company specific risk. Yes, so this is company specific risk, and the reason behind that is that the sales team of Parle is not as aggressive, as qualified as the sales team of Patanjali. Parle can actually improve upon its sales team, but it is not doing so, or it is not capable of making the change. It probably has not even realized that this kind of situation exists. So this is a company specific risk which exists presently. Just because the company is not aggressive enough, the company is not serious enough about its sales. On the other hand, Patanjali is doing much better. So this is an example which shows the difference between Parle and Patanjali. Now, in order to diversify away from Parle, in order to ensure that our investment in Parle does not give us negative or bad returns, we probably can invest in a competitor like Patanjali. So what we are doing is we are diversifying away the risk of bad sales team or company specific risk of bad sales team in Parle by investing in a competitor which is doing better on the same count. Okay, so this is a company specific risk which has been diversified away. On the other hand, the next example says due to financial crisis, sales of Harley Davidson bikes has gone down as mass layoffs or high unemployment leave people with no money or less money. This is market specific risk. So this particular kind of risk is a market specific risk. The reason being that Harley Davidson sales of Harley Davidson have gone down because of high unemployment rate in the country, in let's say US, and so people have less money or no money, and therefore they're not able to spend on luxury items like Harley Davidson. So this tells us that there can also be risks which are beyond the control of a company like this one, which is because of financial crisis, probably because of high unemployment rates, because of less economic growth, whatever the reason might be. That reason is beyond the control of the company, and that is called as a market risk. Okay, so I hope you have understood through the example the difference between systematic and unsystematic, and diversification is possible for unsystematic, not possible for systematic risks. Now let's jump directly towards variance, standard deviation, covariance, and correlation. All these four terms are very important. Whether you are writing RBI exam, whether you are writing UPSC, I think it's very important that you understand these. Very easy to understand, and a lot of concepts are connected with them. For example, you must have heard about Six Sigma. Now that's a concept drawn from standard deviation. If you don't understand standard deviation, it's going to be very difficult for you to understand and appreciate the idea of Six Sigma. Okay, so let's understand variance, standard deviation first. variance and standard deviation are common measures of investment risk. So what do they measure? They measure investment risk, the level of risk in an enterprise, in an investment in a particular stock is measured through standard deviation and variance. Variance is just square of standard deviation, that's the only difference. What is the meaning of standard deviation? The very simply, the meaning is deviation from expected returns. Let's say you were expecting returns of, let's say, 10%, okay, and the standard deviation is plus minus 1%. So now you will either get a return of 11% or a return of 9%. Keeping in mind the standard deviation, your return will vary. What if there is another stock wherein also you are expecting returns of 10%? The standard deviation is, let's say, plus minus 3%. So your returns are going to vary from 7% to 13%. There's going to be high volatility in returns, a gap of 6%. Herein the gap is only 2%. This is what we mean by standard deviation. A particular investment which has high standard deviation is more risky because the downside is 7% here. The downside in case of the first investment was only 9%. Okay, so you're losing out more in case in case the company goes bad, in case the investment goes bad, in case there is some kind of a risk involved which results in you earning less returns. Okay, so standard deviation is telling us the deviation, the movement, whether it's plus or minus from the expected returns. Higher deviation means more risk. It's as simple as that. So that's the only difference. Let me explain to you very briefly. It's not mentioned here, but let me explain to you very briefly the idea of Six Sigma and how it is connected with standard deviation. Let's say you have identified, let's say there is a Coke bottle. Okay, let's say there is a Coke bottle here, and this is, let's say, 500 ml Coke bottle. Okay, now this is still in the process of manufacturing. Thousands and thousands of Coke bottles are being manufactured on a daily basis, are being bottled on a daily basis, and you have this first Coke bottle, 500 ml. Let's say you get hold of or you buy another Coke bottle. This is also 500 ml, 500 ml, another Coke bottle. Okay, now you have some stuff in here which is supposed to be drunk. Okay, so what happens is the bottle says that there is 500 ml of sweet water in there, but in reality it might be 495 ml. You cannot be sure that it is 500 ml, it might be 495, and in the other bottle it might be, let's say, for 90 ml. You might have a third bottle wherein the total might be 505 ml or let's say 506 ml. So there's going to be some variation in the exact amount or volume that is being bottled inside that Coke bottle. 500 ml does not mean exact 500 ml. Now there is going to be, because the company wants to ensure that in order to maintain the quality, that all the Coke bottles have 500 ml exact or as near as possible, and for profit motive also, for ensuring that the company is not losing out on profits by bottling more or bottling a lot less, it also wants to ensure that there is 500 ml in every Coke bottle. How does it do it? It measures a standard deviation. It measures an accepted rate of deviation. Let's say they find out in ml terms that the accepted rate of deviation is 5 ml. Okay, so if a particular Coke bottle is between 495 to 505 ml, then there is no problem. The company is going to accept it as it moves out of the factory. If there is a Coke bottle which has 490 ml in it, then the company knows that that particular bottle has moved out of the standard deviation that had been accepted, which was 5 ml. So there is something wrong in the enterprise because the deviation is more than expected. The expected deviation was, or the standard deviation was 5 plus minus. The exact deviation is minus 10 or plus 10. So now the company knows that something is wrong. So it can go back to its factory bottling plant. It can identify where in the process did it go wrong. What happened that in place of 495 or in place of 500 ml, that bottle was filled with 490 ml of sweet water. So that is called a standard deviation. Standard deviation helps us in ensuring that what we want to achieve, what we want to maintain in our manufacturing or services plant or anywhere else, we are able to do that by identifying the standard level of deviation which is acceptable and then comparing it with the actual deviation. Okay, the same is here. Standard deviation tells us the level to which, whether plus, whether minus, the level to which the return can deviate. If the expected return is 10%, standard deviation is plus minus 1.5, we know that it should deviate between 8.5 to 11.5. Okay, if the standard deviation is 3, we know that it should deviate between 7 to 13. But if it actually deviates more than that, or if the standard deviation is high, we mean that we know or we have identified that the risk is more. So I just explained that through an example to you: plus minus 10%, plus minus 1, 10%, plus minus 7%, 3%. Okay. Variance, as I had said, is just the square of standard deviation. Now let's jump to the idea of covariance and correlation. So what standard deviation is telling us, it's telling us the level to which one particular investment is risky. If the expected return is 10%, standard deviation is plus minus 3%, we know that it's a very risky investment that we are making, because the variation is going to be very high, 7% to 3%. Okay, now what covariance and correlation tell us is the relationship between two or more stocks. So this is on a standalone basis that we have identified. Well, what about if there is another stock wherein the return is 13% and the standard deviation is plus minus 3%? Can you actually compare them? No, it's going to be very difficult through standard deviation, through variance, to compare them, because the expected returns are different. Okay, let's say the deviation is also different, plus minus 2%. Now it's become more difficult to compare them and identify which one is better, and mathematically to prove which one is the worse off. So in order to make that correlation, in order to make both these asset classes, both these portfolios comparable, we use correlation and covariance. Covariance, simply, as you can see in the graph, measures the extent to which two variables move together over time. So if you have covariance, you can see that in this particular graph you have covariance, you have positive covariance here, but we don't know the intensity to which the covariance exists. Okay, I'll be explaining that very soon. So here simply try to understand covariance is the level to which they are moving together. As you can see, if this is first, let's say this is first, and this one is second. So first stock and second stock, as you can see here, first stock is moving up, the second stock is also moving up, first stock is moving down, second is also moving down, first is moving up, second is moving up. Again, the same thing is happening. So there's positive covariance. On the other hand, if you see here, you can see that there is complete negative correlation here, covariance here, sorry. It moving up, the first one, and the second one. The first one is moving up, the second one is moving down. The first one is moving down, the second one is moving up. The first one is moving down, the second one is moving up. First one is negative now. If this is 0, the second one is positive. Okay, so there is complete negative covariance here between these two particular asset classes, or between these two portfolios. So positive covariance means that the returns are going to move together. Negative means they are going to move in opposite direction, and zero covariance means there is no linear relationship. We don't know what is the impact of first or second, or if first moves down, if first is going down, what is happening to the second. The second might not might also go down. At the same time, the second might also go up. At the same time, the second might not change. So there is no linear relationship between A and B, these two portfolios, if the covariance is 0. So this is something that you should remember. It can be asked in the examination also. So I would just mark it as important. Please try and remember this from the PDF once you go and read it. Okay. Now we have understood what is covariance, but the problem with covariance is that it does not tell us about the degree of relationship. Okay, it does not tell us if let's say, for example, covariance is 77 between stock A and stock B. If you look at this example, it says the covariance between stock A and stock B is 77. So we know it's positive 77, but what about it? Like how do we compare it with the other one, with anything else? There is no comparison possible. So we don't know how strong or how weak the covariance or the relationship is. In order to identify the intensity, the strength of relationship between two particular portfolios or multiple portfolios, you use something called as correlation. So correlation is an improvement over covariance, Covariance just tells us whether the relationship is positive or negative or zero, but it does not tell us the intensity, the level to which they are connected, they are related with each other, and that degree of relationship is expressed through correlation. Correlation, that's why varies from -1 to 1. Okay, it lies between -1 to 1. So correlation, the example here says correlation of +1 between stock A and stock B says that there is perfect or complete positive relationship between A and B. If A moves up 10%, let's say, okay, let's take an example and understand this. Let's say that the returns being provided by A were 11% at the starting of this year. It is expected to move 10%. That means 10% of 11, 1.1. So by the end of this year, it's going to be 12.1. If there is complete positive correlation between A and B, let's say B returns were 12% this year, and if A moves 10%, B is also going to move 10% because there is complete positive correlation here. So it's going to be 1.2, 13.2%. Okay, so that is called as complete positive relationship between A and B. If A moves up 10%, B moves up 10%. If A moves down 10%, B moves down 10%. Okay, if A moves up 20, B moves up 20. If the relationship or if the correlation is 0.5, that means that if A moves up 10, B moves up 5%. If A moves down 10%, B moves down 5%. So relationship between, or the degree of relationship between A and B is 0.5. If it is 0, no impact. If it is minus, negative. If A moves up 10%, B moves down 10%. If A moves down 10%, B moves up 10%. So this correlation, this relationship between A and B or multiple portfolios is called as correlation, and it's very important. It's actually used very intensely and very widespread usage in stock markets because it helps the investors to identify how do they mathematically diversify their portfolio in order to arrive at the best possible portfolio that they want to have. Okay, so we have understood variance, covariance, standard deviation and correlation. Let's take certain examples to make it more clear. The first example says an investor buys a share of stock for $40 at time t0, that is today. He buys another share of stock for $50 at time t1, that is after 1 year. He sells both shares for $60 each after 2 years. The dividend is 1 per share at t1 and t2. We have to find out the internal rate of return. So internal rate of return we've already covered in financial management. So if you've not covered it, please cover that first. Move sequence wise, do not cover this first. There will be some topics which will be repeated here out of the older ones. Okay, so cash flow at 0 we have identified is -40 because it's a cash outflow. What are we doing here? We are buying a stock, so money is going out, that's why it's a cash outflow at year 1, that is 40 rupees. Cash outflow in year 2 is 50 rupees is going out. We are buying certain stock, but also we are at the same time we are getting $1 as dividend on the stock that we purchased in year 1. So in total we are losing out $49 for purchasing that stock. In third year we are selling both the stocks, and at the same time we'll also be getting $2 as dividend. So our total inflow, that is plus, is going to be 122. Internal rate of return is nothing but identifying the rate of return at which NPV is 0. That means that certainly means that outflow is -40 in year 0, then you have -49 in year 1, and we bring it down to year 0, and we have a cash inflow of 122 in year 2. This is the inflow at year 2, 1 plus k e raised to power 2. So this cash outflow should be equal to cash inflow. That means NPV should be 0 in order to find out the internal rate of return. So the KE at which NPV is 0 becomes our internal rate of return. I hope it's very clear now. So let's move forward and talk about the second question. The second question says in a 5-year period, the annual returns on an investment are 5%, 3%, 4%, 2% and 6%. the standard deviation of annual returns on this investment is closest to. So we have to find out standard deviation in this particular question. Very simple question, in fact. So what we have is we have annual returns which are 5 minus 3 4. So we find out mean, because standard deviation is always around the mean. In order to find out the mean, you just add these 5 terms and you divide it by 5. So the mean comes out to be 1.2%. Now you find out the standard deviation with respect to this mean. So 5 first year 5%, mean is 1.2%, standard deviation is 3.8. The mean was 1.2, so your mean returns for 1.2%. That means you should have earned 1.2% on a yearly basis. But in year 1, you actually earned 5%. That means you earned more than the mean. So your standard deviation or your deviation is positive in nature in year 1. In year 2, you should have earned 1.2%. You actually lost money. You did not earn anything. You in fact lost money, minus 3%. So your mean, your deviation is negative, minus 4.2. In third year also you lost money. In fourth year you gained some money because you should have earned 1.2, but you actually earned 2% return. In fifth year you should have earned 1.2, you actually earned 6%. So again it is 4.8%. So there's a lot of positive and negative relationship here on a year on year basis, and when you square it you find out that the variance is 82.8, and then you again find out you square it to find out the variance. So variance is 82.8, and then you find out the standard deviation by so this is the variance for the 5 years. For variance for all the years together comes out to be 20.7%. Here it is n minus 1, that is 5 minus 1. That's the formula, not required for us. If you want to know, it's n minus 1. You can also have it, look at it in the PDFs that I provided, and the standard deviation comes out to be square root of 20.7 because we squared it here to find out variance. So standard deviation comes out to be 4.55%. So the standard deviation here is 4.55% that we have identified. That is what you wanted to know. The third question says a measure of how returns of two risky assets move in relation to each other is what? How returns of two risky assets move in relation to each other. As I had explained, if there is this particular this particular graph, is one is moving up and the second is also moving up in relation to this, so there is perfect correlation here. As you can see here, there is perfect correlation here. So the relationship or the level to which one is moving up in relation to each other and the second is moving down is given by covariance. Very simple. We've just read it, so I believe you can easily answer this particular question. Next question is, which of the following statements about correlation is least accurate? About correlation is least accurate, that means incorrect. Diversification reduces risk when correlation is less than 1. I had explained to you what is the meaning of perfect correlation plus 1, what is the meaning of 0 correlation, and what is the meaning of minus 1 correlation. Diversification reduces risk when correlation is less than plus 1. If correlation is 0, a zero variance portfolio can be constructed. Zero variance portfolio. The lower the correlation coefficient, the greater the potential benefits from diversification. The lower the correlation, the greater the potential benefits from diversification. Let me explain it to you so that you are able to understand it. What exactly is this saying? You might have got confused. I think first one is clear. Diversification reduces risk when correlation is less than 1. When correlation is, let's say, 0.9. So if A is moving up 10% plus 10%, B will have 0.9 of 10%. So B will move up by 9%. So diversification is going to reduce risk when correlation is less than 1. So if there is A is like minus 10%, B would be minus 9%. So correlation is less than 1. That's why the negative impact on B is much less than the negative impact on A. So you're diversifying and reducing your risk. If correlation is 0, a zero variance portfolio can be constructed. Now zero variance portfolio would be at minus 1. Why? If A moves up 10% and the relationship, the correlation is minus 1, B moves down 10%. So what is the net impact? Net impact is 0. So zero variance can be constructed only when the correlation between them is -1. That is, they are perfectly negatively correlated. If it is 0, if the correlation is 0, what would have been the impact? The impact would have been B would not have got affected, and so the net deviation would be 10% only. Okay, if A moves up 10%, B does not move at all because there is zero correlation. So the total variation is 10%. You have not diversified risk to the level that your variance is 0. Okay, so I hope that is clear now. And the third one is saying the lower the correlation coefficient, the greater the potential benefits from diversification. If the correlation is -1, your risk becomes 0, so your diversification is completely perfect. But at the same time, your returns are also going down. Okay, so the correct answer here, or the least accurate answer here, is B. Let's take the last question for today. Which of the following statements about risk-averse investors is most accurate? About risk-averse investors. Seeks out the investment with minimum risk while return is not a major consideration. So to find out the most accurate. Will take additional risk if sufficiently compensated for this risk. Avoids participation in global equity markets. This probably, I believe, you must have understood, is completely incorrect. Okay, easily can be found out. Seeks out investment. A says seeks out investment with minimum risk while return is not major consideration. That was a question of how risk tolerant are you. Okay, that is a question of how risk tolerant are you. If you are highly risk tolerant, you would take maximum risk in order to increase your returns. If you are less risk tolerant, you would take minimum risk, even if it means that your returns are not so high. So if your risk tolerance is negative, then you lie here. If your risk tolerance is less, then you lie here. But risk averse does not in any way mean this. All investors are risk averse does not mean all investors want to minimize their risk and do not care about the return. Every investor cares about the return. The level to which they want to minimize or maximize risk comes under risk tolerance. So B is correct because B says will take additional risk if sufficiently compensated for this risk. Okay, if you are risk averse, you will take additional risk only when you are compensated for that risk in terms of return. Okay, so I hope you have understood this. This marks the end of this particular lesson. In the next lesson, we are going to move forward and talk about efficient frontier, CML, SML, CAPM, a lot of things, and we'll make it very clear. I'll ensure that we understand the entire CAPM theory, the entire CAPM, the idea of capital asset pricing model. And I'm trying to remove mathematical calculations as much as possible to ensure that you understand and you are able to visualize what exactly standard deviation, what exactly these terms like covariance, variance, correlation, CAPM, CML, SML, all these mean, and we'll try and simplify it much more. Take care. If you like this lesson, please subscribe to the channel. You can also press the bell icon in order to get regular notifications about my future lessons. And if you have any queries, any doubts, any feedback, you can provide it to me in the comment section below. All the very best. Take care. Have a nice day.